All right. Thank you, everyone, for joining today. I'm Clayton Whitfield, one of the co-founders of SaaSOptics, and co-hosting today is Lauren Kelley, CEO and founder of OPEXEngine. Lauren will tell you a bit of her own bio in a few minutes, but just a quick bio for us at SaaSOptics. We started SaaSOptics in 2009, and the product is a direct outgrowth of our experience trying to run our previous business, which was a subscription business. We had a nice result from that business. It had gotten acquired in 2007 by a public company, but the challenges of trying to manage GAAP revenues and renewals and contract management and all that and generate useful metrics out of a spreadsheet, because bigger systems were simply too expensive for us, are what led us to build SaaSOptics. And well, that and our long experience in subscription businesses. Among the founders of SaaSOptics, one or more of us have been managing subscription businesses since 1998, so we've been at it a long time. And as these things sometimes go, the company that acquired us in 2007 happened to be a customer of your co-host today, Lauren Kelley from OPEXEngine. So we've known Lauren for several years and always wanted to do something cooperative because her solution's awesome and we think it complements ours very nicely. So let's get to that. So SaaSOptics gives you fast, accurate metrics and revenues, and OPEXEngine gives you great objective industry numbers to compare them against, so it's a natural fit. And we're very grateful to Lauren for all the time and energy she's invested in all of this. And the flow today is I'll start with SaaSOptics and metrics, and then I'll hand it over to Lauren to take us home with OPEXEngine and benchmarks. So why subscription metrics? Well, for those of us that have been in subscription businesses for a long time, it might seem incredibly obvious, but to make sure we set the right levels today, it's worth hitting the high notes. So for subscription businesses, financial statements alone don't give you enough information to make business decisions, and they don't give potential investors a complete understanding of your performance. As an example, revenues on an income statement can look great, but they might be masking serious problems in your business that metrics can easily identify. We'll actually see an example of that later when we jump into some of the reports in SaaSOptics. There are also performance indicators, just like occupancy rates in a hotel business or airlines with passenger loads. And the last bit is they enable you, your senior management, your board, to drive your subscription business as Ben Franklin would have us do. Everything from pricing and packaging to hiring to just low-level nuts and bolts resource allocation decisions can and should flow from good, consistently defined, accurate metrics. So how do you get them? Well, most people use a spreadsheet, but you really shouldn't be. It's not that you can't do it in Excel. It's that if you are doing it in Excel, you're spending your time on the wrong things. You're spending your time generating and sanitizing rather than analyzing your data. Excel is a hugely powerful tool. I use it all the time, but it should be a complementary tool, not the main tool in your financial management. And SaaSOptics, based on our experience, why we built SaaSOptics, makes it easy to get you there. So that's us. We're affordable, cloud-based financial management for emerging subscription businesses, and we do two functionally very different but complementary things. We do subscription management, RevRec and reporting, renewal management, invoice automation, all of that, and we do subscription metrics. And this mix of functionality is chosen very specifically because, as we said in the beginning, based on our experience, to drive your subscription business, you need both great GAAP financials and great metrics, and SaaSOptics gives you both of these very quickly and very affordably. So the majority of our customers come to us for the subscription management part. Their revenue spreadsheet has become unmanageable, or they're trying to raise money and they need to get GAAP compliant really quickly. But some customers come to us just for this, as evidenced by our Zuora customers. They use our Zuora integration, pull the data over into SaaSOptics, and they come to us largely for these reports. We don't have a lot of time today, so we have to keep it high level. So what I hope to leave you with is how quickly and easily you can get consistently defined, accurate, real-time key metrics out of SaaSOptics, which frees you to spend your time analyzing your data rather than generating it. So let's jump into the application now, and we'll check out a few of our reports. So as you can see, we can create tons of reports. We're only looking at a sliver of the application today. We can create many, many reports that let you slice and dice your metrics, and on the revenue side over here with your finance reports. But given our time constraints today, we're just going to focus on these three. So I've filtered my reports to just show these three. So why these three? Well, these three are the most sought after and the most complex, and that's the first reason. The second reason is if you're not doing these now, you should be. And the third is these are somewhat to extremely difficult to do in Excel. They're very, very easy in SaaSOptics. So today we'll be focused on MRR momentum, customer lifetime value, and MRR cohort reports. So I'll start with the MRR momentum report. Again, these are critical metrics and the ones we hear the most about. And this one is, you can see in the format that was made famous by Bessemer. We call it the momentum report because that's what's important. An individual MRR number is nearly meaningless. The context is everything. So most of you probably know how to read this, but for those of you that don't, we'll just run through this really quickly. We're going to focus on the January 2013 column. And what this is telling us is we started January 2013 with about 330K in MRR from existing customers. At some point during the month, we added about 40K in MRR due to new customers signing up. We lost about 6K in MRR due to customers that canceled. We added about 1,800 in MRR due to customers that upgraded, and we lost about $600 in customers that downgraded. And then we ended the period with this, which rolls forward to be the beginning balance of our next period. So it's a pretty simple report, but there's a lot of powerful information here. And you may remember that I said earlier that good revenues can mask serious problems in your business. Well, that's actually exactly what we're looking at here. This is demo data, so it's not real, but it's actually a good reflection of a real life customer issue. They had great top line revenue growth. They're racing to go public. And if you asked any of them, they would say they had a land and expand sales model, meaning their sales growth was predicated on selling more services and upgrades into their existing customers. And they had too many transactions to really manage it in Excel to get anything other than a simple sum MRR number every month. So they, in effect, had this number, this top number here. And it was growing nicely, just like it is here. You can see over the course of January to December, nearly 100% growth in MRR. And if you looked at an income statement with these numbers, you'd also see approximately 100% growth in revenue. But remember, their sales model was a land and expand model. So this expansion number that you see here should have been going up, and it wasn't. And this contraction number should have been small and declining, or at least holding steady, and it wasn't. It was accelerating, just like it is here. So what that meant was the sales model they thought they had, that they'd been investing in both operationally and financially for years, was completely broken. And when they loaded their data into SaaSOptics and ran this report and the customer lifetime value report, which we'll see next, they went absolutely white because it was immediately obvious that their top line performance had been disguising a serious systemic issue. And at current speed and course, they were less than 12 months away from going upside down on their revenues. So, oh, and by the way, a couple of analysts at the firm actually had their suspicions about this issue, but there was simply too much data for them to get their hands around it in Excel, and they hadn't been able to see credible, real numbers that they got in just a few seconds out of SaaSOptics. So a couple more points here. One is, like all of our reports, this one is very simple to build. This is it. This is the entire construction of that report. And there's some more detail I can add too. If I want to see CMRR, all I have to do is make that simple choice, click go, and now the system will run through and get the CMRR and put it in the report in concert with my MRR momentum. Another option is, and this one is very difficult to do, or at least time consuming to do in Excel, is if I want to see the customers that underlie those various MRR categories, all I have to do is make that choice and click go, and it runs through the system and puts those customers in their respective MRR categories. Very difficult to do in Excel, very simple here. In a few seconds, you can get a more complete report than you could have gotten in a couple of hours fighting with a spreadsheet, and now you can spend your time analyzing instead of generating your data. Next report is CLTV, so just keep moving here. You'll see that this report, the construction of it, is nearly identical to the MRR report, MRR momentum report that we just looked at. The difference is gross margin and monthly discount rate, and we can give you your customer lifetime value. So this is a different set of data here, so instead of an impending disaster, we're actually looking at some healthy performance. But I'm going to hold up right here because we could spend 30 minutes on the calculations alone in this report. Given our time constraints here, I'm just going to hit some of the highlights and keep moving. So the first thing to notice is this reads more like a dashboard than a report, and that's because we have multiple reports embedded here. Here's the MRR momentum report we just looked at. Here's a customer account report in the same format. Here are your revenue metrics, revenue churn, retention rates, average MRR and expansion MRR stuff. Here's your customer metrics, your logo churn. And then you get down to the good stuff down here, average customer lifetime revenue and average customer lifetime value. You can see, again, healthy behavior here across our customer lifetime value. CLTV is a really powerful number, and it can inform a tremendous number of decisions, pricing and packaging, resource allocation. We don't have time to get into all of them, but a really easy example is most people have some idea of what their customer acquisition cost is. So if your CAC is way below this number, then maybe it's time to scale up and spend some money on sales and marketing. Just a simple example that can flow from these numbers, and now you can make data-driven decisions around the value of an individual customer. Also, another thing to note, if you were to try to replicate this and all the calculations in this report in Excel, first of all, it'd take you absolutely forever. It would likely be wrong by the time you got done with the first pass, and it would definitely be wrong when you tried to add the next month's data, which would set off another epic round of spreadsheet fixing, which I'm sure all of us have lived through before. So avoid all that. Let us calculate and generate, and you spend your time on analysis. Next report, MRR cohort. So there's a reason this one is so sought after, and anyone who has ever created a cohort report in Excel knows how awful it can be, but you frequently don't have any choice. We speak to a lot of VCs, and the vast majority of our customers are VC funded, so we know that this report is often a condition of getting funded, which makes perfect sense because VCs can glean a ton of insight about your business from this report, but that's actually great news because it means you can too. So for those of you that are not familiar, the way to think of these individual cohorts I think is an easy way to think of it is as incoming freshman classes and how they perform over time. So as a quick example, this is our incoming freshman class. They started with us in April of 2012, and this is the sum of MRR of everybody that started with us in 2012, and this is what happened with that sum of those specific freshmen or customers over time, and that's how they performed. So we don't have time to go into all that can be learned from this report, but a couple of points. One thing I'd want to see, it's a very easy one, I want to see this number, this starting number, growing over time, because it means we're getting better with each passing month at adding new business. Another thing, back to our April freshman class here, can I correlate the performance of this cohort to something specific that we did? You can see they started here and they churned out just over a year later. So did we do something here in April 2012? Did we maybe run a discount or something that caused this crew to sign up, but after the discount expired, they all churned out or something like that? So there's a lot that I might be able to tease out of this that's related to events in my business. And then the last thing I'd want to do is I'd want to slice and dice this report. You can do it with a lot of ours, with all of our other reports, but this one in particular, I'd maybe like to slice cohort by market segment or cohort by sales rep or sales team and see how the performance differs over time. So like all of our other reports, this one is very simple to construct. That's it, all you do. And since I mentioned slice and dice, I'll just show you a quick example here. If I wanted to see performance by sales rep, all I do is choose my sales rep here, and so now I'm looking at cohort performance by my favorite sales rep, Benjamin Franklin. So that's it. Again, let us generate you spent your time in analysis. I'll hand this over to Lauren so you can learn how to take your internal numbers, some of which are these kinds of metrics, and benchmark them against objective industry data for better performance and better decision making. Take these numbers and move your decision making to a higher order.
That's great, Clayton. Thanks so much for that description of your great product. It's amazing what you guys can do, and we've been so happy to see a number of our clients work with you, and they're very happy about the results that they've seen. So I'd like to start my presentation off today just introducing OPEXEngine and myself quickly. As Clayton mentioned, the company that purchased his prior company was a client of OPEXEngine. I started OPEXEngine about 8 years ago after 25 years in the software and SaaS, not really SaaS, but software and a little bit of subscription world. Started up some fairly large businesses, took a company public, our technology group, which then a couple years ago was bought by Oracle. So I started OPEXEngine with a couple of other people because we had found it just ridiculous that there was very little good quality information out there for people running companies themselves. There is great data out there for investors, but very little data that is out there purely to serve the needs of people starting, building, growing, expanding businesses. So that's what we do at OPEXEngine. We run a benchmarking survey once a year, and we work with companies. We've worked with hundreds of software and SaaS companies over the past 8 years, and some of the leading companies out there, companies that have gone public, using our benchmarking, building up to that point and after they've gone public. So it's been a terrific time to be in the industry. So what I thought I would do is focus, just following up on Clayton's description of the metrics that they track, and just start the presentation off making the point that the problem in our space today in the SaaS segment is that there are a lot of performance metrics out there and a lot of great work that's been done talking about how important these metrics are, but the definitions typically are not consistent. And one of the most important things that you need to know is that this is not a standard defined metrics. None of these, virtually none of them are GAAP metrics, and most of them were not tracked 10 years ago. So each company tends to define them differently. Investors will define them differently. So use them. It's incredibly important, but know what you're using, and also be cautious when you look at other people's numbers or when someone touts a particular number as the right number for your company. So what we do at OPEXEngine is we work with each company. Each company inputs their own data into our system. And so we work very closely with them to identify and clarify what goes into that. So for example, churn rates. We look at it from two perspectives. One, the customer retention rate, in terms of looking at if you had 100 customers at the end of last year that were your customers on contract, and if you look at that same cohort of customers at the end of the current year, what percentage of them are currently active on your system. So we see from our benchmarks, and these are sort of some of the high-level groups, but we break it out also by size of revenues, by business model, by companies selling large average contract sizes versus companies selling smaller average contract sizes. We tend to see a couple of trends. We see that venture-backed firms tend to have slightly higher churn rates overall than companies that are not using venture money. And I think that's because we also see that the venture-backed firms have extremely high growth rates. They're putting that investment to good use to grow, but with high growth oftentimes goes somewhat higher churn rate. And we see the companies that are not venture-backed, that are growing more slowly, but are able to, and the basis of their business requires that they have much lower churn rates. And we also tend to see that the net dollar renewal rate is always higher than the number of customers, which means that companies are landing and expanding. They're growing their contract values per customer. So that we also tend to see another trend. We tend to see companies that have smaller average contracts tend to have higher churn rates. Companies that have higher average contracts tend to have lower churn rates, and that makes sense. Typically, if you're selling a $100,000, $200,000 subscription, it's typically an enterprise application. It's a longer sales cycle, a lot more resources, both on the part of the vendor and on the part of the customer, have been applied to making the decision. And it's not a decision that they're going to change quickly. If someone buys a $1,000 or $2,000 product, it's usually a single user, a productivity tool, or a small business application, and there's not as much process that's gone into that. There may be other competitors out in the market, so there's higher churn typically with that kind of customer, and that's just the nature of that business. So we also look at very detailed benchmarks around expenses, but just looking at the summary here of total expenses, simple fact, I think it's not a surprise to anybody listening that SaaS companies in the private sector, and particularly, I mean, private SaaS companies, particularly venture-backed firms, are spending over revenues. What is interesting when you look at the data over the last couple of years, the amount of venture money going into early stage and sort of mid-stage, the 10 to 20 million and over 20 million in that pre-IPO stage, hopefully, the amount of money that's been going in has been increasing, and the growth rates tend to be quite high. This is just a visual to give you a sense of you know, for most of these companies, this is looking at public companies, taking a cohort of public companies under about 300 million last year. It's just a nice visual showing you how closely the market cap multiple to revenue and revenue growth, how closely they are aligned, except for in a few exceptions that sort of prove the rule that the rest are closely aligned. So the market and investors have been rewarding highly, very high revenue growth. And you can see also just looking at the first quarter of this year compared to first quarter of last year, market caps are, the percent change quarter over quarter was 55% increase. That may go down when we look at the, certainly will go down, I would think, when we look at full year 2014, but we're not there yet. And the multiple increased by about 30%. That's for the whole group. And clearly at that point, revenue growth has been the key, one of the key factors in terms of rewarding companies in the market. But there are some indications that that's slowing, and that more complex views of the factors that drive valuations. But just from an operational perspective, to look at differences in spending in terms of sales and marketing, G&A, R&D, that hasn't changed that much last year over this year so far. We'll see how that goes in the rest of the year. And I think some of the metrics that are driving valuations, and that we're seeing a lot of work in developing metrics for that and looking at the benchmarks, is in the areas, continuing in the areas of customer success, customer acquisition, and the sales and marketing process efficiency in those areas. But we're also seeing some focus operationally on the cost and the investment in security, performance, and redundancy, and also growth in international markets, and the return of the channel, selling through more than one tier, whether it's through direct and indirect or other kinds of channels. So I want to wrap up my presentation. Again, this is a very quick overview of benchmarking. Is one of the things that we focus on with companies is helping them understand how to compare their data, how to compare the benchmarks to their own data, and understanding whether the numbers are relevant. And some key points there to keep in mind is really that one number out of context really has very little meaning. If you, for example, think about cost of customer acquisition, you may hear from someone, oh, the cost of customer acquisition for a company like this, the benchmark is $50,000. Out of context, that means nothing. It depends on what your peer group is. If you're a company selling large average contracts and your customer lifetime value benchmark is $500,000 or $1 million, then $50,000 would be fabulous. $100,000 would be fine. But if you're in a peer group of companies where the average contract value is $5,000 and your cost of customer acquisition is $50,000, then that is not a relevant benchmark. So you want to look at your sales and marketing model and make sure that you're getting benchmarks correctly there. Is your goal as a company pure revenue growth, or is it profitability? As we saw, if you look at the benchmarks between venture-backed firms and non-venture-backed firms that are bootstrapped and self-funded, there's a big difference in how they're run and where they spend money. Are you an early stage company and someone keeps telling you the benchmark for Salesforce.com? Salesforce.com is a more than $4 billion company, so that's not probably a relevant peer benchmark. So just to wrap up on just showing a little bit of what we do, companies input their data so that they can see right in the same place, in the same context, in the same format, benchmarks against a variety of companies. And if I go back just in closing to Clayton's description of what a great example of a company that thought they were doing great, they have great revenue growth, but their land and expand model is broken. So just think about the finance person who's pulled together this analysis and needs to then go talk to the VP of sales and explain that that needs to be changed. Here's the problem. And human beings being the way they are, the VP of sales may say this data is not correct, or this is not where we should be. But if you combined that internal information together with a variety of peer benchmarks, when I say variety, meaning from different peer groups, so that also when the VP of sales says, and I've been a VP of sales, so I know all the arguments, when that VP of sales says, well, these benchmarks don't mean anything, that's not my company, not our kind of company, that's not what we're trying to achieve, and you can flip among different peer groups and say, okay, well, let's look at it this way, and here's the benchmark for what the expansion should be for our kind of company. It just makes for much more effective and powerful conversations. So the benchmarking is really about information, so that you have the information for budgeting, for planning, but it's also about communication. And on that note, let's conclude. Thank you so much, everyone, for your attention and interest in the subject, and we'd love to talk to any of you further. Please feel free to contact myself or Clayton with any questions or comments or further conversation. Thanks very much.
Indeed. Thanks, everyone. And thanks so much to Lauren for all of her work on this. Thanks for attending, everyone.